Hi, my name is Richard Purnell from the Mortgage Home, and we are your buy-to-let experts. Now, in this video, I want to talk about income protection policies. Now, if you've got one already or you're thinking of getting one, you really should please spend 3 or 4 minutes just listening to this bit of content, because otherwise it could be an expensive mistake if you don't. Now, just before I get into explaining what I mean by that, please, if you haven't done already, just click the subscribe button. That means that you'll get a little tap on the shoulder every time we drop a video, and you'll know to jump in, and then you can watch it at your leisure. Now, income protection policies. First of all, I want to explain what they are, and then I'll get into the key element that I need you to understand. Now, first of all, what are income protection policies? Now, if you, whether you're employed or self-employed, if you have an accident or you're sick and you're unable to work, that's the underlying point, that's the key message, then you're not going to get your wages, or you're unable, if you're, let's say, a tradesperson, you can't go out to do your work, so you're not invoicing your customers, and the money's going to slowly dry up. So the income protection policies, you claim on it, it kicks in, and it supplements the wages or replaces the wages until you're fit back to work, and then the claim stops. It's a very simple policy. The ability to claim, and you might want to jot this down if you're interested in this type of policy, is that your GP signs you off as not fit for working. That's it. It doesn't matter what illness, it doesn't matter what sickness, it doesn't matter when you did it. It's simply that you're unfit to work. So that's the trigger. You put your claim in, and it will pay your, as I say, wages or profit. Now, that might be for a month. It could be, I mean, when you're talking these things, you should talk worst case. What if you never went back to work? What if the condition or illness was such that you could never go back to work again? It happens. Well, these policies will continue to pay you until retirement. You are taken care of. It's a massive safety net for you and your family. So who can benefit? Well, we've got two groups of people. We've got the employed, we've got the self-employed. Employed people, well, with these guys, if you have a modest employer, you're not, it's not the NHS, it's not the public sector or a blue chip company, then your work sick pay scheme might be at best a couple of weeks of full pay, or at worst, none at all. It's just statutory sick pay. And if you've never looked that up, I'm not going to go into it today, but just look up statutory sick pay. It'll tell you what it is. It's very modest. And I'd be surprised with a mortgage or a family and lifestyle expenses, it's unlikely to cover those costs. So it will mean you stay in a sticky financial situation. Now, what about self-employed? A little easy to understand. You're on your own. You don't have a business behind you. It's just you, and you have an illness or some sort of sickness or an accident, can't work. Well, what's going to happen? Now, look, if you've got savings, happy days, you can jump into those, start to eat them up. Maybe that's what it's there for, contingency, rainy day. But what if you don't really have much savings? Then this, again, is where the policies come in, and it will pay your equivalent profits until you're fit to return to work. Now, here's the crux and the key learning point. These policies are split into two camps. We've got guaranteed premiums and reviewable. So again, after this piece of content, please, if you've got one already, look the policy up. See if you can find out, have you got guaranteed? Have you got reviewable? If you're not sure, you could send us copies of them. You can, in the good old days, you'd fax them through to us, or you can take pictures, scan them through, and we will take a look, and we can advise you about what you have and whether that is fit for purpose. Now, let me explain guaranteed policies. If you've got a guaranteed premium, that means the premium is never going to change throughout the life of the policy, unlike a reviewable that every year will increase. Now, it's increasing not by some exponential, ridiculous amount. We're talking about an inflationary increase, so 2 or 3% once a year. So it's modest, but it is cumulative, and it is, of course, incremental. So over time, it's going to start to catch up the guaranteed premium, and eventually, if you have it for long enough, it will overtake and become more expensive than the guaranteed. So that is the crux of the decision that you're making when you're looking at these things. If you got them online, I suspect you never even had that conversation with yourself. The online company would probably never even explain that you had guaranteed and reviewables. That's where an advisor comes in. Now, it's best described, which is best, by this next graph. If you look at the orange horizontal line, of course, it never moves. This example is at £46 a month for the next 20 years. That's the life of the policy. But look at the blue line. It starts off at under £20 a month. It's significantly cheaper than the guaranteed premium. And it takes, in this example, around 12 to 13 years to actually catch up, as you can see here, to the orange line. And you're now paying a similar amount, £45. And of course, beyond that, you'll start paying even more. But here's the thing. What if your risk period is only the next 2, 3, 4, 5 years? Let's say, for example, you're growing a business. And by the time, in 5 years' time, you expect to have a team of people working with you. So if you are ill, if you are sick, the team's still out there. The business still functions. You still are going to be making the profits. Whereas right now is where you're at high risk because it's all on you. And if you're ill, there's no income. It stops, as we said earlier. So it might be that these policies are only for the short to medium term. In that case, I would be leaning more to a reviewable policy. Of course, it's all subject to advice. I'm not giving advice here. But you can see the benefit of these reviewable policies if you're only looking at in the short term. If you're expecting, a large sale of something, if you're expecting inheritance, if you're expecting a lump sum of cash to come in the future, and that becomes your insurance policy, then again, it might work out that the reviewable is a lot cheaper for you. So I hope that's given you some food for thought, and it's challenged your thinking about all guaranteed and the reviewables are a little risky. And listen, we have an advisor in the office, Yvonne. She's amazing. She's our insurance advisor. She'll give you more information. She'll give you quotations. She'll give you the equivalent of this graph so you can see when that break-even point is and you can make some real informed choices. So if you do want to have that chat, below the video in the comment section, there's a link to our diary. Book some time in with Yvonne, and I'm sure she'll be able to help. Other than that, thank you for watching the video and look out for the next videos that should be dropping in the next week or so. Have a fantastic day.